Folks, who wants to save money and drive to the bottom line in their portfolio? This week on the Prereal podcast, we have Erik Oliver from the Cost Segregation Authority. He walks us through some cost segregation tips and tricks and some neat new things. It was really informative for me. The 179D, the 45L, these are amazing tools in the toolbox here, and money that's available for us to take advantage of that most of us are not. We're so damn busy hustling and working to build our portfolio. We're not taking advantage of all of these opportunities to save on taxes. And that's the best, quickest, easiest, cleanest way to drive revenue, right? Is to optimize your current portfolio, not stack doors, not stack square footage. There's a time and a place for that, but it should be after you've optimized it. So this week, please give it a listen. Erik Oliver, tremendous information, really valuable stuff.
Are you ready to bring your real estate game to the next level? My name is James Prendamano. I'm the CEO and founder of Prereal, and over the past 25 years, I've closed over $1 billion in transactional real estate. Each week, I'm meeting with outstanding investors, high-performing individuals, and visionaries operating in the real estate space. These are the people that are actually out there in the real estate game right now getting it done. This podcast aims at bringing anyone's game to the next level. This is the Prereal Podcast.
Welcome, everyone, to the show. We're joined today by Erik Oliver. Erik is the Vice President of Business Development with Cost Segregation Authority. He holds a Bachelor of Applied Sciences in Accounting from Westminster. He's got an interesting background, and we're going to focus today, folks, on cost segregation. We're going to take it kind of from the beginning and really start small with what cost segregation is at its truest form. And we're going to work through some of the changes that we've seen in the CARES Act and how it can impact you and ways to optimize the portfolio, because that's what we're all here for. With that, Erik, thank you so much for taking the time today.
Yeah, no, glad to be here, James. Appreciate the opportunity.
Yeah, man, I appreciate you getting on. We were talking before we started recording in the green room, if you will. Erik, as we all seem to be, is suffering from pretty bad allergies. So I appreciate you being a trooper today and hanging in there with us, man.
Yeah, no problem. Hopefully I won't cough my way through this. I'll just hit mute if I've got a cough or sneeze. So I apologize in advance.
All good, man. We're here for your wisdom. So let's jump right in. Could you spend a minute or two on your background for the audience, just to get a sense of who Erik is? You were living in Long Island. You've now moved out west. You know, where did this all start for you?
Yeah, so just kind of taking it back to my college days, my background is in accounting. So when I was in college, I hated writing papers, and math always came somewhat easy to me. So I'm like, okay, what's the quickest way I can get out of here? And it was either finance or accounting. So I got an accounting degree, never really used it, got into sales, which took me to the East Coast. I was born and raised in Salt Lake, and took a sales position in Virginia. Lived there for 12 to 13 years. Met my wife. My wife was born and raised in Long Island, New York. And so after doing sales, I decided to go work with her father. Her father has a landscape business he's had for 30 years. He was looking to retire, and so wanted to go up there, learn the business from him. We were going to buy the business. Things didn't work out. He decided he didn't want to retire after we had been up there for 5 years. And so we decided to head out west. So like I said, I was born and raised in Salt Lake. When I came out west, didn't know what I wanted to do, was just looking online for different jobs, came across cost segregation, didn't even know what it was myself. I had one rental property prior to that, but was unaware of what cost segregation was. Started looking into it, and I'm like, wow, this is interesting stuff. And with my accounting degree, it might not be a bad occupation. So took a job with Cost Seg Authority, been doing this for 7 years now. Love what I do, love learning about real estate, get to meet great mentors throughout the country in terms of real estate and accounting. And so really love what I do now, and been able to help people save money through cost segregation on their taxes, which has been great.
Cost segregation is highly specialized. It's something that you hear thrown around quite a bit, but very few people who really are experts in it. And we love the fact that your firm does cost segregation. It's not part of 52 other services that you provide. Is that accurate?
That is accurate, yeah. So we've got 3 services here at our company, and that's deliberate. We want to partner with CPA firms and investors across the country. And so we don't do tax returns here at our firm. We will partner with CPAs and say, hey, let us be the specialist when it comes to this cost segregation. You guys file the tax returns. You guys are the specialist in that area. But when it comes to real estate and taxation, let us be the specialist. And I always look at it like, your CPAs are kind of like general practitioners. They have to know a little bit about a whole lot of different subjects, earned business income, child tax credits, audits. And it's not that they're negligent, they just don't have the bandwidth to dive deep into depreciation in real estate. Some CPAs will specialize in real estate, but most are kind of your general practitioners. And so that's really where we come in, partner with them, get them involved and say, hey, you've got a client who owns real estate. Is there an opportunity there for us to use our expertise to save them some money on their taxes? And so most CPAs are pretty open to letting us come in and work with their clients in that capacity.
At its core, what is cost segregation? What is depreciation?
Sure. So let's start with depreciation. So the IRS allows you to depreciate your real estate. So real estate, if you think about a building, every year you own that building, it becomes older and older. And in theory, it's worth less and less. Now, that's not always the case with markets, but the building itself, the stucco on the outside is worth less in year 10 than it is the first year you get it, for example. So the IRS knows that these buildings are going to deteriorate. And so they allow us to take a expense or a depreciation expense every year against our income. So for residential units, your multifamily units, those all get depreciated over 27 and a half years. Commercial units, retail, office, that gets depreciated over 39 years. And that makes sense. A residential unit where you've got people living in those units, they're going to deteriorate at a faster rate than an office building that's open 9 to 5. So that's why you see the discrepancy there. You got 27 and a half versus 39 years. Just to make the math easy, let's say I buy a single family home for $275,000. In theory, I'm going to get a $10,000 write-off every year for the next 27 and a half years. You just take your building value. Now, I kind of oversimplified. You do have to pull the land value out. Land is non-depreciable. So, but if you've got a building and the building is purchased for $275,000, you take that, divide it by 27 and a half years, that's a $10,000 write-off every year, which is great. That's why a lot of us get into real estate, is for some of these tax benefits, or one of the reasons why. But what if I'm not going to own my building in 27 and a half years from now? I've got a 5-year plan. I'm going to fix it up, let it appreciate, and then I'm going to sell it. I want my deductions now versus spread out evenly over 27 and a half years. And the way you do that is through an engineering-based study called cost segregation, where you actually go into that building. When I buy a single family home, I'm not just buying the land and the walls. I'm also buying some appliances. I'm buying some concrete in my driveway. I'm buying some trees and some bushes and some shrubs and some mulch and some countertops and flooring. All those things I mentioned, the IRS says you should depreciate those. They don't last 27 and a half years. You should depreciate those at a faster rate. And so through a cost segregation study, a firm will come in and they will identify the different assets within your building that can be depreciated at a faster rate and move those into different buckets per se. Now, there's a number of reasons why you want to accelerate depreciation. There's time value of money. A dollar today is worth more than $1 27 and a half years from now. There's inflation is a hot topic. Inflation is going up, time value of money. So I want as much of my deductions that I can get, I want them now versus letting the IRS hold on to these. And so that's why when you segregate your building into different components, it allows you to front load or take that depreciation at a faster rate.
So let's dispel a few rumors, if we will, out of the gate. So you addressed the land one already. Can I depreciate a primary residence?
No. So revenue generating properties. So Yeah, you're not allowed to depreciate your primary residence.
Second home.
Maybe.
If you're smart with leases and you write it up the
Yes.
right way. Okay.
Yes, if it's set up the correct way, yes, you can. You just can't, in theory, you can't spend more than 14 days a year there. Otherwise, it's considered a second home, which you cannot depreciate. But yeah, it can definitely be set up. A lot of people will set up their second homes. They Airbnb them while they're not there,
Mhm.
and you can take depreciation on those.
If I accelerated depreciation on a building and I'm essentially writing those losses off today, I can use that to offset earnings in other places.
Correct. Yep.
Okay.
It doesn't have to be, you do a cost seg on this building, it can only offset income from this building. It creates a passive deduction that can offset any other passive deduction you have in your portfolio.
Right. So
For
folks,
most
if you,
people, there are some active deductions for real estate professionals, but for the most part, it's a passive deduction that can be used to offset passive income from any other source.
a lot of changes came down with the CARES Act. For those who don't know, it's I believe it's the Coronavirus Aid, Relief and Economic Security Act. Is that right?
Very good.
All right.
Yes.
So in the CARES Act, there were some changes as far as the amount of years you're allowed to depreciate your asset over, correct?
Not quite. So let me just back up a step. So the CARES Act, the big changes on the CARES Act were some of those energy credits we talked about. So we'll touch on those here in a second. There was a few things that affected cost segregation with the CARES Act, being able to carry back some of your deductions. But I think what you're referring to, James, was now I'm drawing a blank. It was the it was the Donald Trump tax overhaul. That was in 2017.
Okay, the Jobs Act.
There you go, Tax Cuts and Jobs Act. I'm like
Yep.
drawing a blank here. Yeah, the Tax Cuts and Jobs Act. So with the Tax Cuts and Jobs Act, something came out, or something called bonus became more prevalent. Bonus depreciation had been out for a number of years before the Tax Cuts and Jobs Act. And the government uses bonus depreciation kind of as a lever to stimulate the economy. So if the economy is not doing well, then they'll increase bonus. If it's doing well, they'll decrease bonus. When Donald Trump was president, obviously Donald Trump owns real estate. And so there was some changes made with that Tax Cuts and Jobs Act that are very important for real estate investors. And that is that they changed the way that bonus was realized. So prior to 2017, in order to take advantage of bonus, you had to buy something brand new. It couldn't be an existing piece of equipment or an existing building. You would have to build a brand new building. And it was 50% bonus at the time. After the Tax Cuts and Jobs Act, that changed dramatically. So the two things that changed is, one is it became 100% bonus, which was massive. And two, they added 5 words, it was pretty slick the way they did it. They added 5 words to the tax code that said, new to you, the taxpayer. So no longer had to be, I didn't have to go out and buy a brand new bulldozer. I could go out and buy a used bulldozer. That used bulldozer is new to me, the taxpayer.
Yep.
And now I get to take bonus on it. So let's talk quickly about how this impacts real estate. So in the past, in order to take advantage of the bonus, you had to build a new fourplex. You couldn't buy an existing fourplex. With the changes to the Tax Cuts and Jobs Act, it allows you to now go buy an existing fourplex. But remember that fourplex by nature is a 27.5-year asset. Bonus only applies to assets that have a useful life of 20 years or less. So a lot of your CPAs out there are like, well, you can't take bonus on real estate because real estate's a 27.5-year asset. I'm reading my tax book here. It says, in order to take bonus, I've got to have an asset of 20 years or less. What they don't realize is that if you do a cost seg study on your fourplex that you just purchased, we're going to come in and we're going to identify all the 5-year assets, things like carpets, countertops, cabinets, appliances, ceiling fans, garbage disposals. We're going to put a value to all those components. Those all have a useful life of 20 years or less. So now they are eligible for bonus. And guess what? It's not even 50% bonus. Remember, it's 100% bonus. And what that means for real estate investors is whatever value we put to those 5-year assets, you get to write off or depreciate 100% of those in the first year. So you're taking a 5-year asset that normally gets split up over 5 years, which that's great because that's way better than 27 and a half. But now I'm taking this 5-year asset and I'm depreciating it all in the first year.
My understanding of it, and correct me if I'm wrong, because I'm certainly not an expert on this, I can take the full value of that piece of equipment. Let's say I put 10% down and I finance the balance, right? So I'm only
Sure.
out of pocket 25 grand. I've got a payment that's 4,000 a month. I could take a full $250,000 deduction that year.
Correct. Yep, you hit it on the head. That's a
Wow.
100% bonus. Now, one thing to be aware of is 100% bonus. You would have had to buy that piece of equipment, that excavator, between 9/27 of 17, so September 27th of 17, and 12/31 of 2022. So the end of last year. That was that 100% golden era, I call it, because you could take, like you said, you finance it, so you're only coming out of pocket 25,000, but you're getting $100 or $250,000 deduction, which a $250,000 deduction at a 30% tax bracket, do the math on that. That's, close to $100,000 in tax savings if you can absorb it. So that was anything within that time window. Starting in 2023, if I go buy that same excavator for $250,000, instead of getting 100% bonus, I'm now eligible for 80%. So we have what we call a phase out period where bonus is phasing out 20% every year, starting this year till 2027 when it phases out to 0. So this year I would get, I can't do the math in my head. What's 80% of 250? 160 plus another 40. So that's 200,000. So you get a $200,000 deduction versus the full 250. That extra 50,000 that are that extra 20% that's left over, that just gets spread out over the useful life of the asset.
But
But
that goes back to a straight line calculation for the balance.
correct. Yeah. Depending on the asset, it may or may not be straight line, but yes, you spread it out evenly, not evenly, you spread it out over the useful life of the next couple of years. So if let's say a bulldozer is a 15-year asset, you would get 80% in year 1. The other 20% gets spread out over the next 14 years.
Now, we used a piece of equipment in this scenario. Does it apply to real estate proper?
Yeah. Let me give you a quick example on real estate. So let's say you buy $1 million 8-plex. Let's say we determine the land is worth 200,000. So now you've got 800,000 of what we call depreciable basis. You do a cost seg study on that $800,000 building. On a multifamily, we usually find somewhere around 30% of the assets in that building are short-term assets. So 30% of 800,000 would be $240,000 worth of short-term assets. Again, that's us coming in saying the carpet's worth 20,000, driveway's worth 80,000. We're going to come up to somewhere around 240,000 or 30% of your building. That 240,000 is all in class lives less than 20 years, which means it's all eligible for bonus. So if you bought that building this year in 2023, you're going to get 80% of 240,000 that you get to write off in the first year. So 80% of 240, I can tell you real quick, 240 times 0.8, that's $192,000 write-off in the first year. Now remember, $1 million building, if you put 20% down, you're out of pocket 200,000, but you're getting $192,000 write-off for that building in year 1, which is amazing.
So in this new window that we're in, and how long does this window last? This is 1 year each 20%?
Yeah, so the 80% bonus lasts through the end of this year. So any properties that you buy and place into service in 2023, they're eligible for 80%.
It's not about stacking doors and stacking square footage. It's about optimizing first. And I think we're doing ourselves a tremendous injustice. We all work so damn hard for our money if we're not exploring all of these avenues thoroughly with an expert that understands it far better than we do.
Yeah, and I'll just add to that, James, you hit it on the head. I'm trying to remember the gentleman I talked to, but he put it perfectly. He said, as investors, we're always looking to play offense. We're always looking to go buy the next door. What we lose focus of is playing defense on all that money that we've earned. And so how do we maximize it? And one way to maximize that money we've earned is by reducing our tax bill. And it's something that a lot of people, like you said, we're so focused on playing offense that we forget, hey, if I just play a little bit of defense, it doesn't matter if you score 200 points in a basketball game, if the other team scores 201, you've lost.
Yep.
You've got to play some defense here. And we oftentimes will lose focus on, and you've hit it on the head. I appreciate you bringing that to their attention, because that is something that goes underutilized quite often is, hey, just go buy another building. Let's go build. Let's go do this. It's like, wait, we can make just as much money with the stuff we have if we could just reduce our tax bill. And we've got all this property that we've never done a cost seg on. And if I can create $100,000 in tax savings, that's just as good as go buying, X amount of doors. And so,
it's far better, brother, because you don't have the extra calls, the extra maintenance, the extra payrolls,
Sure.
the extra insurance, the extra headaches, right?
right.
And
No, you hit it on the head.
we're so focused on pedaling the bike and moving this thing forward that we forget there are ways to do this. So especially today with all the craziness out there, I think we have to slow it down enough to pay more attention. I know we are for sure with our existing holdings. So let's jump real quick and talk about the 179D and the 45L. Now, those did come from the CARES Act.
Correct. Yeah. Well, some changes to those did come from the CARES Act. Yes.
Okay. Can you talk the audience through what these benefits are?
Yeah, so the 179D, let's jump into that first. The 179D is a deduction that's eligible for developers who are developing new commercial real estate. So if you go buy an existing building, it wouldn't apply to you. But if you build or expand an existing commercial space, or excuse me, if you build or expand an existing commercial space, do tenant improvements, you may be eligible for a portion or all of this deduction. Now, what this deduction is currently for the 2022 tax year. I'll talk about that because that's kind of the still where we are in terms of tax timeline. For 2022, it was $1.88 per square foot of a deduction that you may be eligible for if your building that you constructed, your commercial building, is energy efficient. Now, you do have to have a third party come out. They do some modeling. They'll look at the windows. They'll look at the insulation. They'll look at the HVAC, the lighting. If they determine your building is energy efficient, you may be eligible for that $1.88 per square foot as a deduction. Now, the nice thing about that deduction is it just comes off of the basis of your building, and you never have to recapture that upon sale. So one of the most underutilized tax deductions for real estate investors that I'm aware of is that 179D. Now, just keep in mind, it is for new construction or tenant improvements on the commercial side.
It's for tenant improvements on new only, or the tenant improvements?
Improve an existing building. So if let's say I buy an office building and I go in and I put in a new HVAC and new lighting, I may be eligible for a portion of that $1.88 per square foot.
Wow. So, okay, again, I want to make sure I'm capturing this and giving it back to the audience. Let's say we're going to build a 50,000 square foot building new. We're going to build a retail center, an office building, whatever it is. We would do this study and we would be eligible for what would amount to $94,000.
Very good.
Right?
Yeah. $94,000 deduction. So remember, that's a deduction that comes
Wow.
off your taxable income. And the nice thing is you can actually go back. So a lot of people were unaware, a lot of CPAs were unaware of these deductions in the past. You can actually go back to anything you've built since 2005, do the study today or the certification today, take those deductions on your 2022 tax return without having to amend any prior years, which is great. There's some forms you fill out that says, hey, we missed this deduction. We're going to take it now. Here are the forms, and you're able to take those deductions on your current tax return.
From 2005?
Yeah, anything that was built from 2005 forward.
Wow. Okay, that's the 179D.
Correct.
Okay, what about the 45L?
So the 45L is a tax provision that allows, it's a similar program, but it's a credit versus a deduction. So I just want to make that distinction. Remember, a deduction comes off your taxable income. A credit comes off your actual tax bill. So it's a little bit more powerful in terms of, if I've got a $75,000 credit versus a $75,000 deduction, I want the $75,000 credit all day long.
Sure.
Right? So this is a credit that comes off of your tax bill for the development and construction of energy efficient residential units. So the IRS determines a residential unit by 4 criteria. You've got to have a place to eat, sleep, prepare food, and use the restroom. So whether that's a single family home, whether that's student housing, senior housing, if it meets that criteria and it's considered energy efficient, again, you do have to have a third party come certify it. We're going to be looking at stuff again, like the HVAC, the insulation in the walls, the windows, all that stuff. If it meets the certain qualifications, you're eligible for a $2,000 credit per dwelling unit in 2022. That number jumps to $2,500 for stuff put in service in 2023, but $2,000 credit per unit. So if I build a fourplex, my fourplex is energy efficient according to IRS standards, and we have somebody come in and certify it, I'm going to receive a certificate that allows me to take an $8,000 credit against my taxes for 2022.
Let's say you're building at scale, you're putting up 100 units. And your tax bill for that year is $600,000. You would get a $200,000 credit on that 600,000.
Correct. Yep. Instead of paying 600, you're paying 400 because the units you built were energy efficient. Now, I should add the 45L program. It doesn't allow you to go back as far as 2005 because you would have to amend your tax return. So you can only go back 3 years on this through that amendment window where the IRS allows you to change your returns. But I can't tell you, James, how many times I've met with large developers who are building 300, 400, 500 units a year and have never heard of the 45L tax credit. And if they don't take advantage of it within that 3-year window, it's gone. There's no going back and reclaiming those deductions or those credits. So very important stuff. I don't understand why it's so unutilized. The only thing I can think is the IRS did allow some of these programs to expire, and then at the end of the year, they would reinstate it. So there was some confusion, but 2 of the most underutilized credits and deduction, 179D, 45L. The good news is with the CARES Act, with the Inflation Reduction Act at the end of last year, the 179D has been made permanent. So that program will be around for a while. And it is indexed for inflation. So the deduction will continue to go up. So I mentioned $1.88 per square foot for 2022. That number actually goes up to $2.50, all the way up to $5 for 2023 on a sliding scale, depending on how energy efficient your building is.
This is remarkable stuff.
Yeah. So, and then the 45L, as I mentioned, goes from 2,000 up to 2,500. So they are indexed for inflation, but powerful stuff that gets missed quite often for real estate investors or developers.
Erik, can you talk a little bit about the company? Are there only certain states you operate in, or if someone wants to now take the step, right? How do we get engaged? What do we do?
Sure. So we're headquartered out of Salt Lake City, Utah. We do operate in all 50 states. We do studies in all 50 states. Always get an analysis done beforehand. Most cost seg companies, most energy credit companies will do an analysis beforehand. So for example, you're building 100 units. I would say, hey, James, send me the blueprints. Let me take a look at them. And I can pretty accurately tell you whether or not you're going to qualify for these credits based off the information in those prints. At that point, if you do qualify, you would engage us. We would come out, look at the property, identify the different units that are out there that qualify. Same thing on the cost seg side. The IRS does require that we do a site visit. Once that site visit's done, we're going to provide you and your CPA either the certificate or the report to be able to take advantage of these deductions. I should add on the cost seg side as well, always get an analysis done. Most companies do those analysis. We do them for free. You tell us, hey, this is the address. This is what I paid for it. This is how long I've owned it. This is the type of building it is. Within 24 to 48 hours, I can come back to you, James, and say, okay, you bought an apartment building in 2017, we think, and you bought it for $3 million, we're going to give you a conservative amount of at least a $400,000 increase in depreciation in the first year. And can you use that? And we'll get your CPA on the phone. Your CPA, we want to partner with your CPA. They don't have the bandwidth to keep on top of all these different programs. And so we'll partner with them and say, hey, we can create a $400,000 deductions for James, but does James need it? Does he have the income to offset that deduction? Oh, no, he doesn't. Okay, that's fine. We'll just do it next year. Oh, James has some carryover from last year on a cost seg study he did, so he doesn't need any additional deductions. So we'll partner with your CPA and strategize how to maximize the savings, because you want to use these deductions and these credits in years where you're in those high tax brackets. And so, we don't see the full tax picture. And so we want to get your CPA on the phone and say, okay, what is James' income looking like this year? What kind of other deductions does James have? And can he use these? And is this the right time? And so that's kind of the process.
Okay, so as always, all the links and information will be below, folks. Before I let you go, Erik, is there any other high-level things here that we're missing? Any other layups we should lay out there for the audience?
There is one other thing we should probably talk about. And I won't get too far in the weeds because it can get quite technical, but one of the benefits of doing a cost segregation study is we actually are not only saving money up front, but when you sell that asset, we're able to create a permanent tax savings upon sale. And so I'll kind of back into this analogy because I think it makes sense from a high level. But if you buy a building for $1 million, James, and you sell that building 5 years later for $2 million, when the IRS finds out about that transaction, they're going to say you had $1 million of gain, you bought it for $1 million, you sold it for $2 million, and they're going to tax you on all that gain. The problem with that is because you didn't do a cost seg study, you're unintentionally telling the IRS that, yeah, my land is worth double. I bought it for $1 million, sold it for $2 million. My walls are worth double, but my dirty, nasty carpet in my eightplex is being sold for double what I paid for it. And it shouldn't be that way. Your carpet shouldn't be sold for more than you paid for it. But because you haven't broken your carpet out of that transaction, excuse me, because you haven't broken the carpet out, everything's lumped together as that one building. There's no way for you to not pay tax on your carpet. But when you do a cost seg study, carpet actually, this is a good example, carpet's a 5-year asset. So what is the book value of your carpet in that example when you've owned it for 5 years? 0. Has no value according to the IRS. So why are you selling it for double what you paid for it and paying tax on that gain? You shouldn't be. So that's one of the added benefits of doing a cost seg study. When you sell the asset, you can allocate your sales price to the right things, not allocate it to your dirty, nasty carpet. So
you would be able to actually pull those pieces out of the taxable proceeds?
Yes. In theory, what you're doing is you're taking your deduction at a high level. So you're taking your deduction. When I bought this $1 million building and did a cost seg study, I took my deductions at 37% ordinary income rate. When I sell my building, I'm going to pay some of those back in the form of recapture and capital gains, but recapture caps out at 25% and your capital gain caps out at 20%. So take your deduction at a high rate, pay back a portion of it at a lower rate at a future date and save the spread. Wow. And that's really cost segregation, sales price allocation, all that in a nutshell. Take it at a high rate, pay back some of it at a lower rate at a future date, save the spread. So I just wanted to make that point because a lot of CPAs will say, Erik, this is just a timing issue. If you take these deductions up front, you just got to pay them all back in the form of capital gains on the back end. I'm like, yeah, there's some truth to that, but I'm paying them back at 20%. I took them at 37%, and I'm not even paying it all back because guess what? I'm not paying capital gains on my dirty carpet because I've owned it for 5 years and it's a 5-year asset. So that's when the light goes off. All I have to say to a CPA is, you're telling me you're selling your carpet for double what you paid for it? And then they'll sit there and think and they'll go, well, damn, you're right. I am selling the carpet for double what I paid for it. That doesn't make sense. And so that's when we can start the conversation and say, hey, we shouldn't be allocating our sales price to the carpet. You should allocate that to the building or the walls, but certainly not the carpet.
This has been a fascinating chat, Eric. Thank you for kind of gutting through it. I know you're not feeling 100%.
Oh, no, you're good.
Man, this is tremendous information, folks. Erik Oliver, Cost Segregation Authority. Really appreciate you. Thank you very much for joining us.
Yeah, no, thank you for having me.
This
Appreciate
was an absolute pleasure. Always excited to deliver ways for the audience to optimize that bottom line. Thank you for joining us, folks. As always, please stay safe.